A crash didn't happen. That's the headline. In 2025, the US housing market did not implode, it did not reset back to normal, and it did not suddenly become affordable. Prices didn't fall off a cliff, they stayed stubborn. And going into 2026, the same forces that prevented a crash are lining up again. I'm your host, you're watching this channel, and we're going straight at the question everyone keeps typing. Will the housing market finally crash in 2026, or will the affordability nightmare keep going? Here's what happened in plain English in the first 10 seconds. Home prices held up. They did not break. Nationally, the median price ended 2025, slightly higher than the year before. Not a boom, not a collapse, a stubborn grind upward. And that single fact is enough to expose a massive misunderstanding about how housing actually crashes. Because a crash isn't a vibe. A crash is a chain reaction. A real crash looks like this. Sellers flood the market, buyers vanish, price cuts stack on top of price cuts, and the comps start falling fast enough to scare the next seller into panic pricing. That is not what the data has been showing at the national level. Yes, I know you've heard real estate is local a million times. It's true. So let's talk local, and then we'll come back to the big machine driving everything. When you break the country into the largest metro areas, you can find weakness. You can find declines, and those declines are not evenly spread. The soft spots are concentrated. Many of them are in the south, especially parts of Florida where costs have become brutal. Many are in the west, in markets that surged hardest when cheap money was everywhere, and everyone thought prices only go one direction. But here's the detail the crash crowd skips. More metros have still been rising than falling. Most of the country is not in free fall. Even with pockets bleeding, the national average has been held up. So the story of 2025 was not collapse. The story was split screen. And that split screen is the key to understanding 2026. Because the big question is not whether some cities can drop. They can. They already have. The big question is whether those drops spread fast enough, wide enough, and deep enough to trigger a national crash. To answer that, you have to stop staring at charts like they're horoscope lines and start looking at the forces behind the chart. There are three forces that matter most: inventory, mortgage rates, and liquidity. Let's start with inventory, because inventory is the silent assassin of the crash narrative. A crash needs supply. A crash needs listings. A crash needs desperate sellers. But most homeowners are not desperate. They're locked in. Millions of people are sitting on mortgages that feel like a cheat code from another era. 2%, 3%, low fours, payments that look fake compared to today. So ask yourself, why would they sell? If they sell, they don't just lose a house, they lose their payment. They trade a cheap fixed cost for a painful one. They trade stability for higher monthly burn. That lock-in effect is why inventory has stayed tight. It's why the market can feel dead and still not crash. Because dead volume is not the same thing as falling prices. A thin market can keep prices elevated if there aren't enough forced sellers to drive the comps down. Now let's talk mortgage rates, because rates are the accelerator pedal for demand. When rates shot up, payments exploded. That's what froze buyers. Then rates drifted down a bit, and people expected instant relief. But here's the catch. Mortgage rates don't move like a light switch. And they don't obey the central bank the way people think they do. Short-term rates are one thing. Mortgage rates live in the long-term bond world. They are tied to long-term yields and inflation expectations. That's why you can get rate cuts and still not get cheap mortgages. The bond market can keep the leash tight. So what are the big institutions expecting for 2026? Not a miracle. Most forecasts cluster around the idea that mortgage rates stay in a similar range, maybe slightly lower, but still far from the ultra-cheap era. Translation, don't expect a wave of 3% refinances to save anybody. That world is gone. But here's the twist. Even a small rate drop can matter because it doesn't have to return to 3% to change buyer behavior. When you've been stuck watching rates in the mid-sixes, a move into the high fives feels like oxygen. And oxygen brings demand back. Now stack the third force on top. Liquidity. This is the part most people ignore because it sounds abstract, but it is the backbone of the entire affordability crisis. When the money system gets easier, assets get supported. When the money system tightens, assets get stressed. And going into 2026, the policy direction is leaning easier, not tighter. Rate cuts are one tool, messaging is another, and balance sheet actions are a third. If liquidity expands, it tends to leak into assets. That doesn't mean prices must explode. It means the floor gets reinforced. And when the floor is reinforced while supply is tight, you don't get a crash. You get a squeeze. Here's what that squeeze looks like in real life. Food is up. Utilities are up. Insurance is up. Repairs are up. Childcare is up. Everything that touches a household budget is heavier. Wages rise, but not at the same speed. So households feel poorer even when the economy is fine. When they can't save as fast, their down payment grows slower, their debt feels heavier. Meanwhile, the unit of measurement, the dollar, keeps getting diluted over time. That's why when you look at the last couple decades, the pattern is obvious. The median home price in the early 2000s looks like a different universe. Not because homes became magical, because money became cheaper. So when people say, why won't home prices crash? Sometimes the answer is uncomfortable, because the currency is doing what it always does in a debt-based system. Now, let's bring this back to 2026 with a clean, simple logic chain. If rates drift down, demand returns. If liquidity stays loose, assets get supported. If inventory stays tight because owners are locked in, supply remains constrained. So where does the crash come from? A crash needs a trigger powerful enough to override lock-in, override policy support, and override the natural tendency of people to fight to keep their homes. What triggers can do that? There are only a few. They're all ugly. Trigger 1, unemployment spikes hard and stays high, not a mild slowdown. A real job shock, because when people lose income, mortgage payments become impossible. Forced selling appears, distress appears. Trigger 2, credit breaks, lending standards tighten dramatically. Buyers vanish because the loan approvals vanish. Trigger 3, a flood of inventory from a specific group, like investors dumping or a wave of new supply landing at once in the same markets. If you don't get one of those, you don't get a national crash. You get noise, you get pockets, you get a slow grind. And that's why my base case for 2026 is not finally the crash. My base case is the affordability crisis persists. Well, not because I like it, because the incentives point that way. Think about the politics for a second. A nationwide housing crash doesn't just hurt investors. It hurts millions of normal households who already own. It slams local tax bases. It hits banks. It hits consumer confidence. Systems don't voluntarily choose chaos when they can choose managed pain. So the system chooses managed pain. That's the split between the haves and the have-nots. If you already own, even a flat market can still feel like winning because rents rise and replacement costs rise. If you don't own, flat prices can still feel like losing because payments stay high and savings don't catch up. This is why first-time buyers are getting pushed later and later in life. The door isn't closed for everyone, but it's narrower, higher, and guarded by monthly payments that punish you for being new. Now let's talk about construction, because every time affordability comes up, someone says, just build more. In theory, yes. In reality, building is chained to costs. Materials are more expensive than they used to be. Labor is more expensive. Permits, fees, delays, regulations, insurance, and financing costs all stack up. So builders face a cruel math problem. The affordable home is often not profitable to build at scale. And if builders can't profitably build cheap homes, they build fewer homes. That keeps inventory tight, that keeps prices supported, and that keeps the affordability crisis alive. Now layer in something even messier, region-specific cost bombs. In some states, property insurance has become a silent second mortgage. In some areas, taxes jump. In some areas, maintenance and HOA costs creep up. Those costs don't show up in a national median chart, but they absolutely change behavior. That's why you can see price declines in certain pockets even when the national chart stays stable. The market is not one market. It's hundreds of micro-markets, all reacting to the same rate environment but different local pressures. So what do I expect in 2026? I expect a continuation of the split screen. I expect softness to persist in overheated, high-cost regions where the total monthly burden has become a choke point. I expect relative strength in regions where supply is constrained and employment is stable. I expect the national number to stay stubborn because the average is being held up by markets that simply refuse to produce enough inventory. And I expect a psychological trap that could make 2026 even more frustrating for buyers. Here's the trap. If rates drift down even modestly, it creates hope. Hope brings buyers back. Buyers coming back into tight inventory doesn't fix affordability. It just changes who is suffering. Instead of nobody can buy, it becomes some people can buy, and they fight for the limited supply. That supports prices, so you don't get the crash. You get the same high prices plus renewed competition. That is the nightmare scenario for first-time buyers. The year where prices don't fall, rates don't fall enough, and wages still lag. Now, let me be clear. I'm not saying prices cannot drop. They can. They will, in some places. If you're watching a local market where listings are piling up, where price cuts are stacking, where days on market are rising, you may get a real opportunity. But you have to stop expecting a national headline to do your work. Housing is local. Your opportunity is local. So here's what I want you watching in 2026, and I want you watching it like an analyst, not like a fan. First, watch inventory in your zip codes, not on national TV. If active listings rise meaningfully and stay elevated, that's your signal that sellers are losing leverage. Second, watch the share of homes with price reductions. Price cuts are the early symptom of stress. Third, watch months of supply. When months of supply climbs, the market shifts toward buyers. Fourth, watch mortgage rates, but watch them alongside demand. A rate drop is not automatically good for you if it brings a stampede of buyers back into the same limited inventory. And now for the cliffhanger, the one detail that could flip the entire 2026 story faster than people expect. If policymakers push the money environment easier than the market is currently pricing, the housing market could surprise people in the opposite direction. Not a crash surprise, a resilience surprise. A market that refuses to give up the discount because liquidity and psychology keep stepping in. That doesn't mean 2026 will look like 2021. The world is different. But it could mean finally the crash crowd gets disappointed again. And if that happens, the affordability crisis doesn't end. It hardens. It becomes structural. It becomes generational. So what should you do with this information? If you're a buyer, the strategy is not pray for a crash. The strategy is hunt for leverage. Leverage comes from inventory. Leverage comes from time. Leverage comes from sellers who need to move. And those sellers exist, but they're not evenly distributed. If you're an owner, don't confuse stability with invincibility. A flat market can still punish you if your payment is stretched and your costs rise. Respect the new cost environment. And if you're investing, do not run a 2021 playbook in a 2026 world. Cash flow matters more now. Costs matter more now. Local risk matters more now. Now I want to pull you back to the original question and answer it cleanly. Do I expect a nationwide housing market crash in 2026 that makes homes affordable for the majority of Americans? No, I expect the affordability crisis to persist. I expect a patchwork market with some declines, some stability, and some surprising strength. I expect the biggest fight to be between tight supply and shifting rates. And I expect the average person to feel squeezed because the monthly payment reality is still brutal. Now it's your turn. Question 1. Do you think 2026 brings a real national crash? Or do you think we get another year of the slow grind where affordability stays broken? Question 2. If rates dip into the high fives, do you think buyers stampede back in? Or do you think people are too exhausted and too priced out to play this game anymore? Drop your answers in the comments. I read them, and they tell me where sentiment is heading. And if you want more straight, no filler updates like this, subscribe. Quick click. It keeps you ahead of the headlines because the housing market isn't just supply and demand, it's policy, it's psychology, it's incentives. And 2026 is shaping up to prove one uncomfortable thing. The crash is not guaranteed, but the squeeze is. But before you click away, you need to understand why this market is so hard to fix, because the reason is not a single chart. The reason is a three-way lock. Lock number 1 is the low-rate owner. Millions of households are sitting on mortgages that are effectively untouchable. They're not going to swap a tiny payment for a massive one unless life forces their hand. That means fewer listings, fewer moves, fewer starter homes getting recycled back to new buyers. That is how you get a market that stays tight even when people are angry. Lock number 2 is the long-term rate problem. The central bank can cut short-term rates, but mortgages are chained to the bond market and inflation expectations. If investors believe inflation risk is still alive, they demand higher yields. If yields stay elevated, mortgage rates don't fall enough to rescue affordability. That is why you can have easing headlines and still feel trapped. Lock number 3 is the build cost problem. People say, just build more, as if homes can be produced like phones. But materials, labor, permits, land, and financing have all moved higher. That means new supply often arrives expensive by default. If the cheapest new home still lands above what most incomes can support, supply does not solve affordability. It just changes the type of buyer who can win. Now here's the twist that makes 2026 dangerous for your expectations. If mortgage rates drift down even a little, millions of sideline buyers will feel hope for the first time in years. Hope creates urgency. Urgency creates demand. And demand, meeting tight inventory, creates price support. That's why the rates down equals prices down story keeps failing in the real world. So if you are waiting for 2026 to deliver a clean nationwide crash, understand what you're really waiting for: a shock that overwhelms all 3 locks at once. That shock usually comes in one of 3 forms: a hard spike in unemployment that forces selling, a credit event that chokes lending and kills demand, or a policy mistake so large it breaks confidence and pulls liquidity out of the system. Until one of those shows up, the more likely outcome is not a dramatic crash. It's more grinding, more splitting by region, more winners and losers, and more frustration for anyone trying to buy their first home. Treat that as the real forecast, not doom, not hype. A system that protects stability even when stability is unfair. And remember, the goal is not to predict a headline. The goal is to read the pressure points before everyone else feels them. Watch listings, watch price cuts, watch days on market, watch your local payment math, not national hype. If the locks finally break, you'll see it in the data first, not in a viral tweet. Until then, assume the squeeze continues and plan your moves with that reality.